Hi students, so let's see next series 2 problems on assessment of individuals. Next problem, compute taxable income and tax liability of Mr. S.K. Podar, resident for the assessment year 1920 from the following particulars. So they have asked to calculate the taxable income and tax liability of an individual person, and they have not mentioned the age. So it is assumed that he is an individual and age is less than 60 years. So based upon that, we need to calculate the tax liability. First one, gross salary amount 3,40,000. So be careful when they're given the information regarding the gross salary or salary, we need to check whether it's a gross salary or the net salary. So gross salary, we need to convert it for net salary. That is nothing but we need to claim the deductions under section 16, that is standard deduction amount, 40,000 has to be minus. So in case if they have directly they have calculated the income called as income from salary or net salary, then no need of calculating the deduction amount. So here they have given the gross salary. So we need to claim the deductions under section 16, that is 40,000 as a standard deduction. Next, rent from house property. Here they have given the rent from house property. It's another head of income. So there is no other income for the house property. So in rent from house property will be taken under the head called as income from house property. And from that we need to claim the deductions under section 24. That is 24(1). One, it is standard deductions at 30% of net annual value, and there is any interest on loan taken for the construction house property, then it has to be taken for the deduction under section 24(2) or B. So here they have not given any interest on loan taken for the house property. So rent from house property as they have given. So from that we need to claim the standard deduction under section 24 at 30% of net annual value. So rent from house property 60,000. Next, interest on bank deposit after a deduction of tax at source. So they have given the net amount. So interest on bank deposit, that is 10,800. So they have already told that the tax has been deducted from the source. So we need to do the gross up amount. So that amount will be taken to the heading called as income from other sources. So net amount has to be converted. So interest rate will be 10% TDS rate. So it has to be converted into gross up amount. Next, income from arrears, it's in casual income. So they have mentioned it is an gross. So amount is 20,000. So we have two options, whether either we can take it to the income from other sources or we can exclude the casual income, and after the claiming the deductions under section 80C to 80U, after claiming the or after calculating the gross total income, then we need to add back the amount called as casual income. Means first we need to take the or we need to calculate the gross total income excluding the casual income, and after that we need to minus the deductions under section 80C to 80U. After claiming the deductions, then we need to add back the casual income. So that is one option, or directly we can take to the income from other sources head only. So income from other sources, they have given the gross, so directly we can take to the after the deductions has been claimed. Next, agriculture income. So we already know that agriculture income is an exempted from the tax. So no need of taking for the income under the calculation of total income. Next, long-term capital loss they have given. So be careful, they have given that long-term capital loss. Now, since it is a loss amount, we need to check whether the loss can be set off or whether we need to carry forward. So already in the theory part, we have seen that long-term capital loss can be set off only from the long-term capital income, not with any other income. So they, in the problem, they are not given any income called as long-term capital income. So this loss can be carried forward for the next years. So long-term capital loss, it will be carried forward. Next, short-term capital gains. If they not mention the word called as liable for security transaction tax, then we need to take in for the calculation of gross total income. If in case they have given the word called as liable for security transaction tax, then after claiming the deductions under section 80C to 80U, for the balance amount, we need to add back the short-term capital income. Here they have not given the liable, so we are going to take for the gross total income calculation. Next, interest on Kisan Vikas Patra gross. So they have given the income called as interest on Kisan Vikas Patra. So this amount can be taken to the 8 called as income from other sources because we cannot take for the first 4 heads of income. Next, life insurance premium paid by the Mr. S.K. Podar out of his agriculture income rupees 10,000. So we already know that he can claim the deductions under section 80C because they're paying the amount or he is paying the amount called as life insurance premium. But be careful, they have told that he is paying the amount from the agriculture income. So in the theory part, we have seen that whenever if any assessee want to claim the deductions under section 80C to 80U, then such expenditure has to be made from the taxable income. If he has made any expenditure from the taxable income, then only he can eligible or he is eligible to claim the deduction. But here he is paying the life insurance premium out of the agriculture income, but agriculture income is not a taxable income, it's a tax-free income. So no need of claim the deductions under section 80C. So let's see the solution part. So assessee Mr. S.K. Podar, status resident, previous year 1819, assessment year 1920. First, we need to calculate the taxable income. So heading calculation of taxable income or total income. So first, they have given the salary information. So they have mentioned the gross salary. So we need to claim or we need to calculate the net salary. So first, take the salary amount 3,40,000 from the deductions under section 16, that is standard deduction 40,000. So 3,40,000 minus 40,000 will get the balance amount 3 lakhs. That is the first head. Second head, rent from house property. So they have not given any other information regarding the fair market value or standard value. So directly we are going to take it as a net annual value. So net annual value is 60,000. They are not given in a month value. So directly we are going to take it as an annum 60,000. Now from that we need to claim the deductions under section 24, that is 24 of 1 standard deduction at 30% of net annual value. So net annual value is 60,000. So from that 30% will get 18,000. So income is 60,000, deduction is 18,000. So balance amount 42,000, that is the income from house property. Next, they have given the income called as short-term capital gains, but we are not taking the long-term capital loss because it's in loss. It should be adjusted or it can be carried forward. So there is no long-term capital gain, so we are just carry forwarding the loss. So short-term capital gain, it is not a liable for security transaction tax. So we are just taking to the calculation of gross total income, that is 24,000. Next, we have given the or they have given the information regarding the income from other sources. So let's see what are the income from other sources. One, that is interest on bank deposits. So they have given the after a deduction of tax at source. TDS has been done, so we need to do the gross up. So gross up we can do using the formula, that is net interest into 100 divided by 100 minus tax rate. So for the security bank deposits amount, interest amount, the tax rate is 10%. So 10,800 into 100 divided by 100 minus 10. So we have done the gross up amount, 12,000 is the income, that is interest on bank deposit. Next, interest on Kisan Vikas Patra, it's also taken for the heading called as income from other sources. The amount is 5,000. So here we are not taken the income from horse races, that is casual income, because we need to add back the amount after the claiming the deduction. That is one option, or we can directly take to the income from other sources. That is the second option. So after salary amount 3 lakh, income from house property 42,000, short-term capital gain 24,000, income from other sources 12 plus 5,000. So totally amount is 3,83,000. So this will be called as gross total income or other gross total income, because we have not included the income from other sources or casual income or long-term capital loss. That's why it is called as other gross total income, excluding long-term capital loss and income from horse race. So balance amount is 3,83,000. Now we need to claim deductions under section 80C to 80U. So only one amount we have, that is the expenditure, that is life insurance premium paid by the Mr. S.K. Poddar out of his agriculture income rupees 10,000. So this can be claimed as a deductions under section 80C only if it is paid from the taxable income. But he has paid the life insurance premium out of the tax-free income, so we are not going to take it for the deduction, or he is not eligible to claim the deduction. So deduction amount, that is 80C, is nil. So balance amount, that is 3,83,000, that will be called as other total income, excluding long-term capital loss and income from horse race. Now we need to add back the amount called as casual income, that is income from horse race. So it is given that it's in gross amount, so we are going to take the directly 20,000, and long-term capital loss cannot be taken for the income because it's a loss. We need to check whether it can be adjusted, but the long-term capital loss can be adjusted only from the long-term capital income. So no long-term capital income, so it can be, or it should be carried forward. So long-term capital loss to be carried forward, nil. So total amount 20,000. So 3,83,000 plus 20,000, balance is 4,03,000. That is the total income. Now, since he is an assessee and individual and age is less than 60 years, so based upon that, we need to calculate the tax liability. So slab rate sits up to 2,50,000, he can claim the exemption. About 2,50,000 to 5 lakh, 5%, 5 lakh to 10 lakh, 20%, about 10 lakhs, 30% will be the tax rate. Now let's calculate the tax liability. That is heading called as calculation or computation of tax liability. First one, tax on income from other sources or horse race, that is casual income, that is 30%. So horse race is 20,000 into 30% will get 6,000. Okay. Next, tax on other income. What is that other income? See, total income is 4,03,000. On that, or in that, already 20,000 we have taken as an income from horse race, that is casual income. So balance amount is 3,83,000. So be careful when you are calculating the tax liability. Already the 20,000 on the casual income we have claimed the, or we have calculated 30% of tax rate, that is 6,000. Now total income is 4,03,000 minusing 20,000, that is casual income. So balance amount is 3,83,000. So 3,83,000 we have taken. Now tax on other income. So we have agriculture income plus other income. So first we need to take the total income, that is other income. 20,000 from agriculture and other income is 3,83,000. Why 3,83,000? Total income is 4,03,000. From that already 20,000 we have claimed the 30% of tax, that is casual income. So remaining is 3,83,000. So balance is 4,03,000. And from that tax on exempted amount, that is agriculture income, it's a tax-free income. So we can claim the exemption 20,000 plus, since he is an individual and his age is less than 60 years, up to 2,50,000 he can claim the exemption. So agriculture income exemption amount plus 2,50,000 is an exceed amount. So total is 2,70,000. So 4,03,000 is the other income. From that exempted amount 2,70,000. Now the balance is 1,73,000. Now we need to calculate the amount on the 1,33,000. So check the slab rates, that up to 2,50,000 the tax amount is nil. From 2,50,000 to 5 lakh the tax rate is 5%. Now the amount is 4,03,000. From that exempted 2,50,000 we have already claimed. So balance amount is 1,03,000. So that fall between the category called as 2,50,000 to 5,00,000 because the difference amount is 2,50,000, but here we got 1,33,000. So it will fall in the category called as 2,50,000 to 5 lakh. So that amount is taxable for or at the rate of 5%. So 1,33,000 is the balance amount we have calculated into 5% is the tax rate. So total tax amount is 6,650. So we have taken 6,650 on the other income. So now calculate the total tax amount, that is income from, or the tax on income from horse race is 6,000 and other income is 6,650. So total tax is 12,650. Now we need to check whether he is eligible to claim the rebate. So the condition says that if the total income is less than 3,50,000, then he can claim the rebate at the rate of 2,500 at a maximum amount under section 87A. But if you check the total income is 4,03,000, which is more than 3,50,000, so is not eligible to claim the rebate under section 87A. So rebate under section 87A is nil. So balance amount 2,12,650. And we need to check whether he is liable or is eligible for surcharge. So surcharge condition up to about 50 lakh 10% and above 1 crore 15% will be the surcharge. Now the income is less than 50 lakhs, so no surcharge will be applicable. And last one, we need to add the health and education cess at 4%. So 12,650 is the total tax amount. On that 4%, we need to calculate the health and education cess. So cess is 506. So total tax amount or gross tax liability is 13,156. Now from that amount, we need to claim, or we need to minus the any advance income tax paid, any TDS has been done, or any amount or interest or penalty we have paid, or taxes has been paid. So if we check the problem, we have the casual income. So already when we are receiving the income from the other person, we have paid the amount called as TDS, that is tax deducted at source. So that amount has to be minus when we are receiving the amount. So less TDS, that is tax deducted at source from horse income, 20,000 is the income. From that 30% we need to pay. So 30% is the 6,000. Now exactly we are supposed to pay 7,156. So we have just added and we have just minus the tax on casual income. So next we'll see the next problem, that is problem 5. From the following particulars of Mr. Gopal, resident, calculate his tax liability for the assessment year 1920. So they have asked to calculate the tax liability. So here they have not mentioned the age as well as the any slab rates. So it is nothing but he is an individual and his age is less than 60 years. So based on that, we need to calculate the tax liability. Now let's see what are the income we have. First one, salary. So here they have given the 1,69,000. They have not mentioned the net salary. So it is nothing but it's a gross salary and we need to claim the deductions under section 16. That is standard deduction 40,000. Second one, business income 70,000. So it is then another rate of income. Next, royalty on books for colleges, that is 30,000. Income from other sources we can claim, and we need to check any expenditure he has incurred for that publishing of books. So no expenditure regarding the royalty. So income from other sources. Next, rent from house property they have given, that is income from house property. So 20,000, and from that we need to claim the deductions under section 24, that is standard deduction at 30% of net annual value. Next, dividend income. So they have not given any information regarding whether it's an Indian company or the foreign company. So we are assuming that it's an Indian company. If they're not given any information, so it is assumed that it's an income from Indian company. So it is fully exempted from the tax. Next, bank interest. So income from other sources 8,800. Income of a minor son 50,000. So this will be called as clubbing of income. Means income from the minor son, it will be added to the resident or the assessee of the person. So if such income is going to claim as in tax amount or the total income, he can claim up to 4,500 as an exempted income. So 50,000 minus 1,500 will be the exempted amount. Next, long-term capital gains they have given. So this will be added after the claiming deductions under section 80C to 80U from the gross total income. So these are the different incomes. Next, contribution to PPF, that is Public Provident Fund. So it's an expenditure, so it can be claimed as deductions under section 80C. Next, the life insurance premium paid, again it's an expenditure, so you can claim the deductions under section 80C. Health insurance premium paid, so this can be claimed under the section called as 80D because he is paying the health insurance premium or medical insurance premium. Next, donation to National Defense Fund. So any donations which has been given for any institutions, it can be claimed as deductions under section 80G. So we have 4 category: 100% deduction with maximum limit, 50% deduction with maximum limit, 100% deduction without maximum limit, 50% deduction without maximum limit. Now they have clearly mentioned that it has been provided for National Defense Fund. So first category, 100% deduction without maximum limit, because any donations which has been given for the national institutions or state institutions or disaster fund, so it is eligible for 100% deduction without any maximum limit. So 5,000 into 100%, so that amount can be claimed as deductions under section 80G. Now let's see the solution part. Assessee Mr. Gopal, status resident, previous year 18-19, assessment year 19-20. So we need to calculate total income as well as the tax liability. So heading as calculation of total income. First one, salary. They have given 1,69,000, deductions under section 16, that is standard deduction 40,000. So 1,69,000, 40,000 minus 40,000, balance amount 1,29,000. Next, rent from house property, that is we have taken as net annual value 20,000, and deductions under section 24, that is standard deduction 30% of net annual value, 20,000 into 30%, 6,000. So 20,000 minus 6,000, balance amount 14,000. Okay, that is the income from house property. Next, they have given the income called as business income. So directly we have taken business income 70,000. Next, income from other sources they have given, that is royalty and books for colleges 30,000. So they have not made any expenditure, or he has not made any expenditure. So royalty on books 30,000. Next, dividend from dividend income, it's a tax-free income, since we have assumed that it is an income from Indian company. So dividend income tax-free. Bank interest 8,800 we have taken directly, and income of minor son already I have explained that it is called as, it comes under the provision called as clubbing of income. So in such a case, the assessee can claim up to 1,500 as an exempted amount. So 50,000 minus 1,500, 48,500 will be the income from, or the income from minor's son. And there is no any other income, so just add it up. Salary 1,29,000, house property 14,000, business income 70,000, income from other sources 87,300, that is 30,000, 8,800, 48,500, 87,300. So totally that is 3,300. And this will be called as the other gross total income, because we have not taken the income called as long-term capital gain, because long-term capital gain and short-term capital gain liable for security transaction tax will be added up after claiming the deductions under section 80C to 80U. So that's why we have called as an other gross total income. Now from that we need to claim the deductions under section 80C to 80U. So first, that is contribution to PPF. So contribution to PPF 3,000 and life insurance premium paid 1,000. So both is eligible to claim the deductions under section 80C. Life insurance premium paid plus contribution to PPF 1,000 plus 3,000, 4,000. Next is paying the health insurance premium paid. So medical insurance premium is eligible to claim the deductions under section 80D. So health insurance premium paid 800. So up to 25,000 he can claim the exemption, and 80C up to 1,50,000 he can claim the exemption. Next amount is donation to National Defense Fund. So already discussed, any amount which has been given for the national or state or the disaster fund, that donation is eligible for 100% deduction without maximum limit. So 5,000 is the contribution or donation into 100% without maximum limit. 5,000 can be claimed as deductions under section 80G. Now, if you check the problem, they are receiving the income called as royalty on books for colleges. So any royalty received, so directly it can be claimed as deductions under section 80 QQB. And that royalty has to be received for the purpose of publishing the books on literary, scientific nature or artistic nature. So the format is whether he has received the lump sum amount or the percentage. So if he received the lump sum amount, first we need to take the amount received from the conversion of foreign exchange within a maximum limit and the lump sum amount received, and whichever is less has to be taken. From that we need to minus the expenditure incurred, and that balance amount has to be compared with the maximum amount of 3 lakhs. So here they have given the amount. So no expenditure has been incurred, so directly 30,000 has been taken, and up to maximum 3 lakh rupees you can claim the exemption. So 30,000 or 3 lakh, whichever is less. So 30,000 is the less amount, so 30,000 will be claimed as deductions under section 80 QQD. Now total deductions, that is 4,080C, 880D, 5,080G, 30,080 QQB, 39,800 will be the total deductions. So other gross total income is 3 lakh 3,000. From that, deductions under section 80C to 80U, 39,800. So balance amount, that is 2,60,500. This will be called as other gross total income. And for that, we need to add back the long-term capital gain, that is 30,000. Now the total income is 2,90,500. Now we need to calculate the tax liability. So we have the income called as long-term capital gain. So on the long-term capital gain, we need to calculate the 20% of tax. So separately, tax on long-term capital gain 30,000 into 20% will get 6,000. Now, if you check the total income is 2,90,500. Already on the long-term capital gain, we have calculated 20% tax rate. So the balance amount is 2,60,500. Correct? So 2,90,000 minus 30,000, 2,60,500 will be the balance amount, that is other income. Now, since he is an individual and less than 60 years, up to 2,50,000 he can claim the exemption. So 2,60,000 minus 2,50,000. So the balance amount will be taken. On that balance amount, we need to claim the, or we need to calculate the tax amount. That is 10,500 into 5%. So 10,500 into 5%, the tax rate is 5. So tax amount is 525. Now total tax 6,000 plus 525, 6,525 will be the total tax. Now we need to check whether he is eligible for rebate condition. If the total income is less than 3,50,000, he can claim the rebate under section 87A. So total income is 2,90,500, which is less than 3,50,000. So he can claim the rebate under section 87A. So maximum, that is total tax into or maximum 2,500, whichever is less. That is gross total tax or maximum 2,500, whichever is less, you can claim the rebate. So 6,525 or 2,500, whichever is less, that is 2,500 is the less amount. So 2,500 will be taken as rebate. So the balance 4,025, and surcharge will be applicable only more than 50 lakh 10%, more than 1 crore 10%. So health and education sets at 4%. So 4,025 into 4%, 160 1. So 4025 plus 161, 4186 will be the total or tax liability is supposed to pay to the government. Okay, let's see next problem. Determine the net income of Dr. Karan for the assessment year 2019-20 from the following particulars. So they have just asked to calculate the net income. So let's see what are the type of income they have given. First one, chargeable business income. So they directly given the business income, where 6,35,000 will be the business income. Next, long-term capital gain in respect of commercial buildings. So any long-term capital gain, it will be taken after the claiming the deductions under section 80C to 80U. So long-term capital gain and long-term capital gain in respect of shares, it will be added up after claiming the deductions under section 80C to 80U from the gross total income. Next, income from sources, they have only given the gross word. So directly it can be taken for the heading called as income from other sources, or it can be added up after the claiming the deductions under section 80C to 80U from the gross total income. Next, winning from lottery net they have given. So it is nothing but we need to do the gross up. So 1,92,500 into 100 divided by 70. So we need to do the gross up amount. Next, expenditure on recovery of lottery prices. So already we know that any expenditure incurred on earning the casual income, it can be claimed as, it cannot be claimed for the as an expenditure. Only the amount which has been incurred by the assessee for the maintenance of the horse races. So this will be ignored. Interest from IDBI. So this will be taken for the heading called as income from other sources. And interest paid on capital borrowed for investment in IDBI bonds. So amount earned in the form of interest from the IDBI is 18,000. So for that earning is going to pay the interest amount for the capital borrowed. So that amount can be claimed as exemption or deductions. So interest from IDBI 18,000 minus interest paid on capital borrowed 18,500 will be 500 amount will be lost. And we need to check whether it can be adjusted either intra-ed or inter-ed. Next, interest on company deposit. So it can be taken under the ed called as income from other sources, because we cannot take for the first 8 of income or first 4 of income. Next, payment of rent for residential house. So if you check that, they have clearly mentioned that payment for rent for a residential house. So any rent which has been paid by the assessee for the purchase or the residential house property, then he is eligible to claim the deductions under section 80 double G. That is, rent paid minus 10% of salary. List of the following has to be taken. That is, rent paid minus 10% of salary, maximum 5,000 per month, or 25% of adjusted gross total income. Okay, so list of the following will be claimed as deductions under section 80 double G. Next, insurance premium paid on life policy, sum assured rupees 90,000, policy taken on 1/4/2012. So any insurance premium, that is life insurance premium paid by the assessee, can claim the deductions under section 80C. But if you see that they have clearly mentioned that he has given, or they have given the information regarding the sum assured, that is the policy amount. So in such a case, we need to claim the amount called as, that is 20% of amount has to be restricted on the policy. So the policy amount they have taken is 90,000 and the insurance premium paid 24,000. So in such, if in case they have given the insurance policy amount, so we need to check the date of policy. So since it has been taken on 1/4/2012, 20% will be the policy amount has to be restricted. So it can be claimed under the section 80C. Next, medical insurance premium on is further. So any medical insurance premium, it will be claimed as deductions under section 80D. Now let's see the solution part. Assessee, Dr. Karanth, status, assumed to be resident, previous year 1819, assessment year 1920. So just they have asked to calculate the net income. So heading calculation of net income, assessee Karanth, previous year 1819, assessment year 1920. So first one, chargeable business income 6,35,000. So 6,35,000 we have taken directly. Next, income from other sources. So already I have explained, if in case they have given casual income, either it can be taken before the gross total income or after claiming the deductions from the gross total income. No compulsion. So income from other sources. First one, income from ORFRAs. So they only clearly mentioned that is in gross amount. So we need to take directly, that is 1,04,000. Next, winning from lottery, they have told that it's a net amount, so we need to do the gross up. So 1,92,500 into 100 divided by 70, because the tax rate on the casual income is 30%. So 1,92,500 into 100 divided by 70. So winning from lottery is 2,75,000. Next, interest from IDBI 18,000, but it has paid interest for the capital borrowed for the purchase of investment or the IDBI securities, that is 18,500. So if you observe, interest income is 18,000, but the expenditure is 18,500, is incurring the loss. Now we need to check whether it can be adjusted with the intra-ed or inter-ed. Intra-ed within the same head of income, inter-ed between the different heads of income. So this 500 can be adjusted with the same head of income because we have the different incomes. Either it may be income from offset or income from lottery or interest on company deposit. So interest on company deposit 48,500. Now income from other sources will be 1,04,000, 2,75,000 plus 48,200 minus loss, that is 500, that is intra-ed adjustment has been done. So the balance amount 4,26,700. Now there is no any information regarding the other rates of income. So directly we need to calculate the gross total income, that is other gross total income, because we have not taken the long-term capital gain. So 6,35,000 is the business income plus income from other sources 4,26,700. Total income is, or the gross total income is 10,61,700. That will be called as gross total income, other or other gross total income excluding long-term capital gain. Now from that we need to claim the deductions under section 80C to 80U. So first one, that is insurance premium paid on life policy, that we can claim the deductions under section 80C since they have given the policy amount and the policy has taken on the date called as 1/4/2012. So if they have taken on the policy on the date called as 1/4/2012, up to 20% you can restrict the deduction amount. That is 90,000 is the policy amount into 20%, or maximum, or the insurance amount paid is 24,000. Whichever is less will be claimed as deductions under section 80C. Means if in the problem they have mentioned the policy amount, then we need to check the date of policy issued. So the policy has been issued on the date called as 1/4/2012. Up to 20% we can restrict the deduction. That is 90,000 into 20% will get 18,000, or the premium amount is 24,000. Whichever is less, that amount can be claimed as deductions under section 80C. So lesser amount is 18,000, that will be claimed as deductions under section 80C. Next is paying the medical insurance premium for his on his father. So 80D up to 1860,000. Since they have not given the information regarding the age, up to 25,000 you can claim the exemption. So 16,000 or 25,000 maximum amount, whichever is less, 16,000 will be the deduction amount. Next, he has been paid the rent on or for residential house property, so he is eligible to claim the deductions under section 80 double G. So 80 double G, so we need to do the calculation, so it will be taken as a working note. So just check the note how to calculate the deductions under section 80 double G. So first, list of the following has to be taken. So what is the list of the following? First, we need to calculate the adjusted gross total income. So adjusted gross total income will be calculated by using the formula gross total income minus deductions under section 80C to 80U except 80GG, because we are going to calculate the deductions under section 80GG. So first we need to ignore the 80GG and we need to claim the other deductions. So gross total income is 10,61,700 minus deductions under section 80C to 80U except 80G. So 80C is 18,000, 80D 16,000. So 10,61,700 minus 18,000 minus 16,000 will get the balance, and that balance will be called as adjusted gross total income. Now by using that, we need to calculate the deduction amount, that is the list of the following. So list of the following, up to maximum 5,000 per month you can claim the exemption. So 5,000 into 12, that is 60,000. Next, 25% of adjusted gross total income. So already we have calculated the adjusted gross total income, that is gross total income minus deductions under section 80C to 80U except 80GG. So we got balance some 10,61,700 minus 18,000 minus 16,000 into 25%. So 2,56,925 will be the 25% of adjusted gross total income. Next, third one, rent paid minus 10% of adjusted gross total income, whichever is less. So rent paid is 1,36,000 minus 10% of adjusted gross total income. So he has paid the rent amount of rupees 1,36,000. From that, we need to minus the 10% of adjusted gross total income. So adjusted gross total income, that is 10,61,700 minus 18,000 minus 16,000. So balance amount is 10,27,700 into 10%. So 1,02,770. The balance amount is 33,230. Now we need to check which is the least of the following, either 60 or 2,56,925 or 3,33,230. So least amount is 33,230. So that will be taken as deduction amount under section 80 double G. Now total deduction, 80C 18,000, 80D 16,000, 80 double G 33,230. So total deduction amount is 67,230. Now net income, that is gross total income is 10,61,700 minus deductions under section 67,002, deductions under section 80C to 80U, that is 67,230. So balance amount 9,94,470, that is the net income. Now for that we need to add back the long-term capital gain, that is 1,17,000 first one, and second one 1,10,000. So 1,17,000 plus 1,10,000, total is 2,27,000. Now total income is, that is net income 9,94,470 plus long-term capital gain 2,27,000. Total income is 12,21,470.